So here in this video, I want to set everyone straight. We're probably going to get a year-end rally. It's obviously not a guarantee, but that's the most likely scenario at this point, given the areas of this market that are duly right to outperform. BMO Capital says, in which I'll play the clip here in just a moment, that small caps are actually going to outperform for the next 3 to 5 years, that you want to be in small caps. And he uses more dramatic words than I am, so I hope you guys like that. Just a moment, we will share that. I do think there is the risk, though, again, of a correction, which could be pretty aggressive in Q1. And I think with the rally in markets that we're seeing, especially if it gets stronger from here, you want to be prepared, okay? I don't give a crap if that means you mow lawns or, well, it's getting cold, so rake leaves for an extra couple $100. You want to do whatever you can do right now to be in a position to buy the dip as much as possible when that dip does come. Okay, we're starting to get more Trump appointees announced, and today the big news was the Treasury Secretary. This is something we've been waiting on for a while. There was some debate on who this would ultimately be, but Wall Street really loved the choice of Steve Bassett, okay? And I think that's important because it could be starting a new trend in 10-year Treasury yields. I talked about this in the last video, but Steve Bassett has the 3 threes, okay? 3% GDP, 3% deficit to GDP by 2028, and 3 million additional barrels of oil to be produced to help get us there. This would not be a government spending-led economic boom. This would be an economic boom. Okay, which is different from what we've seen in recent, years, right? Right now, we're spending money as if we're in a recession. Right now, we're spending money like we're drunken sailors. That, of course, has propped up the economy, at least from the numbers that we see. And that's probably the disparity between, average people feel like they can't get ahead right now, whereas the GDP data continues to come in strong because it's the government just spending money that's propping that up. Well, under Steve Bassett's proposed, plan, which actually is a plan, we haven't heard too many plans with the, Trump presidency, not to, bag on Trump too much, because obviously I think these things are headed in the right direction. This is an actual plan that Wall Street can look forward to. And again, this might start a trend in Treasury yields, which I think is what the Fed wants to see. The Fed has cut rates 75 basis points, yet 10-year Treasury yields have went up 75 basis points. That's not what the Fed was going for. And it could allow the Fed to cut rates more, especially if inflation expectations come down and if Steve Bassett's plan and whatever other plans come about do lower inflation. A lot of people forget this on Wall Street, that the Fed can lower rates. Yes, because the economy disappoints to the downside. That's the unfortunate way to lower rates. The good way that the Fed would theoretically lower rates is if the economy's strong, but inflation surprises to the downside. Nobody's really talking about the fact that inflation might surprise to the downside. And I think that's one of the biggest bull theses that I have for next year in regards to small caps. Now, we can actually see this today with Steve Bassett's plan of extracting an additional 3 million barrels of oil per day. The price of oil is down about 3% today. A lot of threes, I know, but oil is down about 3% today, which does something very important. Now, obviously, in core CPI, we strip out food and energy, so from that standpoint, it's not super impactful, although it kind of is. Technically, this V8 energy drink, which they're delicious, by the way, I didn't produce it. It was shipped to a store in which I drove and picked it up. So even if you strip out food and energy, at least energy does make its way into core CPI, no matter which way you want to put it, because everything you can see in front of you was transported somewhere. Okay, so you can make that argument. But at the same time, oil specifically falling lowers inflation expectations. And inflation is really preceded by expectations more than anything else. Now, again, as I said in the last video, Steve Bessett's plan of reducing the deficit from 7% of GDP to 3% of GDP will lower government deficit spending, which is less government stimulus, more private sector stimulus, or growth, if you will, if GDP is able to grow at 3%, right? Instead of 7% debt to GDP fueling 3% GDP growth, it's going to be hopefully 3% deficit spending fueling 3% GDP growth. So it's more real world growth, okay? Now, inflation expectations are heavily determined or dictated by the price of gas, because it's something everyone reacts to almost on a day by day, certainly a week by week, and a guaranteed month by month basis. People feel when gas is cheaper. People feel it when gas is expensive. So from that standpoint, if we really believe that expectations precede reality, lower inflation expectations should start to take hold even more, which should lower inflation over the coming months. Now, as Tom Lee said earlier today, there's a lot of bears out there. There's a lot of people that are skeptical of this market rally, and it's actually the wildest thing. It seems like everyone's positioned bullishly from what you're seeing, at least what stocks are doing, especially small caps, the Russell, equal weight S&P. Seems like that's doing very well. Clearly it is. But it sounds like, at least somewhere on like an X, right, on Twitter, that everyone's kind of bearish. There is a lot of bearish sentiment, specifically in regards to valuations. And what a lot of people don't understand about valuations is it's really the worst market timing tool you could use. Like, I think like counting the constellations or the cycles of the moon around the earth would probably be more accurate than, you know, some kind of pattern with that. Some people actually use that kind of thing. Would be more accurate than saying valuations are high, so that means markets are going to do poorly. It's just a very bad way of investing your money. Now, clearly, valuations matter when they get to the ultra extreme levels. And actually, you know, on a day like today, where the S&P, you know, was up 1/3 of 1%, valuations really didn't move too much. I mean, you're cheaper right now than you were technically on November 11th. Yet the Russell, the RSP have broken out to new all-time highs. Now, the equal weight is more expensive, but the headline S&P, in which everyone pays attention to, is about the same price as it was 3 weeks ago, 2 weeks ago. So I think this is probably going to continue for a while. Long story short, probably into year end. I'm obviously not a fortune teller, and I could be wrong, clearly. I mean, there's always that chance. But there's a strong case to be had that small caps and cyclicals and value should probably outperform, especially as Tom Lee said, there's $7 trillion of cash on the sidelines that will likely allocate at least some of that back into markets. Would you rather buy an NVIDIA with now slowing growth and, you know, most of the opportunity probably behind it for the foreseeable future? Or would you rather buy small caps trading at a much cheaper valuation with what looks like more favorable policies, potentially less impacted by any tariffs that we could see? Maybe we do get a fall in 10-year treasury yields. I think this is something that a lot of people are not acknowledging. Like, we've heard time and time and again, it feels like over the past couple of weeks, the 10-year treasury yields are going to go higher, right? They're going to stay higher. That's just the new normal. Okay. I disagree with that. I disagree with that 100%. Now, 10-year treasury yields going higher, it's funny. It's good for small caps. It's bad for big tech. Now, it's not necessarily bad for big tech. I should watch the way I say this. It doesn't fundamentally hurt big tech. It just doesn't help big tech the way that it helps small caps. Hence why 10-year treasury yields fell like 14.5 basis points today. And small caps outperformed the NASDAQ by like a 5x ratio, right? Because 10-year treasury yields falling, helps small caps more than big tech. So people like to allocate and chase the areas that have the tailwinds that are benefiting them. Well, as I said in the last video, the Chicago PMIs came out this morning, and they were really bad. The 5th straight month of declines, the worst number we've seen since January. That also had an impact in bringing down those 10-year treasury yields. I mean, what if that's just a glimpse of what we could start to see, which could be slightly softer economic data? Again, not enough to crush the bull thesis, not enough to cause people to scream recession, but maybe enough for investors to say, hey, the Fed needs to continue to cut rates here. 10-year treasury yields are likely to continue to fall and continue to boost up small caps into year end. Now, tomorrow we get S&P Case-Shiller, home price month over month, year over year, house price index. We do get CB consumer confidence. I think that'll be important. We're actually expecting things to get a little bit better than last month. If they come in weaker, then that's, again, a reason for 10-year treasury yields to move lower, just like the data that we got today. You will also get Richmond Fed Manufacturing Index, expecting that to come in a little bit better. Manufacturing shipments, expecting that to come in a little bit better. And Dallas Fed Services revenues, expecting that to come in a little bit better as well. Dallas Fed Services Index expected to get better. And Dallas Fed Services revenues expecting to also get better. And then we have the FOMC minutes coming tomorrow as well. So you do have some economic data tomorrow that could move the needle for markets. Wednesday is the big data. Core PC month over month. Imagine if this comes down and the economic data misses a little bit. That's like the best case scenario for markets right now and would propel small caps even further into this year-end rally. Now we have durable goods orders month over month, expecting that to come in pretty good. GDP growth rate quarter over quarter, second estimate for Q3, expecting that to come down from 3% to 2.8%. Personal income month over month, expecting that to come in line with last month at 0.3%. Personal spending month over month expected to come in at 0.3%. I think that's a pretty important metric. If that misses, then you're definitely going to have more people screaming, we need that December cut. And specifically to help fuel small caps, like, you're barely pricing in a rate cut December 18th. It's 53.7% odds of a cut December 18th, 46.3% odds of a pause. If this starts to grow more and people start to get more confident on a cut, coming in December, that's going to be a positive for small caps into year end, especially if we start to get more optimism about more than 3 cuts next year. That's going to really help small caps into year end as investors position for, hey, what's going to do well next year? Well, more rate cuts, presumably small caps are going to do well, right? As long as we don't cross that line to, oh crap, maybe we go into a recession. As long as we don't get the growth scare aspect, I could see a pretty rosy scenario from now into year end for small caps. So imagine this for a moment. 10-year treasury yields from now into year end fall a little bit more. Maybe they fall to 4.1%. Maybe they fall another 17 basis points. Maybe they fall to 4%, which I think makes a little bit more sense from now into year end. You don't think that's going to help small caps more, mid caps more? I think so. What if the expectations for Fed cuts next year moves from 3 to 5? Not because of a dire recession incoming, but because of the need to normalize Fed policy at a reasonably, reasonable pace, right? 5 cuts next year is definitely not a recession, but maybe it's just enough to keep growth going. Okay, that's the kind of scenario I'm talking about here. Not a disaster, but more Fed cuts. That's going to be very positive for small caps into year end. Now, take a listen to what BMO just said about small caps, because I think they say it a little bit more eloquently than I do. They basically say you want to be long small caps in the next 3 to 5 years because they are undervalued compared to the rest of the markets on any valuation metric that you want to use, which is pretty powerful.
Capital Markets Chief Investment Strategist Brian Belsky is with us today, has an S&P target of 6,700 for next year. Brian, good to see you. Welcome.
Thank you so much for having us. Good morning, Squawking on the Street.
You do write a time for some common sense and prudence and even some humility. What is that about?
Well, so many of our compatriots, other strategists, economists, love to make the big market call. And they've been wrong just trying to call the market. And I think that they've really missed that the stock market is a market of stocks. And that's what's maintained our bullish stance, quite frankly, and consistently. And some people have called us stubborn since 2009 when we came out with this call that U.S. stocks have entered a 25-year secular bull market. Now, it's tough to be bullish that long, especially given all the negativity and all the doubts. And in your first hour today, you had Mr. Cramer talking about sentiment being still negative, and it's true. And even the great Tom Lee earlier this hour was talking about all the cash on the sidelines and investors really doubting this, Carl. And it continues. It just baffles me. But for our sense is this, is that the U.S. market, in terms of an equity asset, remains the best asset in the world, number one. Number two, you get what you pay for. Too many people are focused on valuation. Valuation is the world's worst metric in terms of forward performance. Number three, in terms of what we're going to be seeing over the next 3 to 5 years with respect to U.S. growth, it is going to be consistent. We may have other areas of the world that are seeing quote-unquote snapback growth, but in terms of earnings growth consistency, we continue to believe it's going to be the United States.
So that leads you to what, your $275 number on EPS?
It does. In our base case is 275, Carl, but we think that as we poll our clients and we look at other Wall Street research in terms of the financial sector especially, we think earnings in the U.S. financial sector are massively understated, with a big catch-up trade coming on the earnings front, with the broader theme of scale asset managers and broker-dealers, scale meaning the big banks, but also their very small banks we think can do very, very well. And just polling our clients that we speak with, we continue to believe that the majority of clients on the institutional side are at best neutral, meaning market weight financials, and there's more to come there.
So you sort of poo-pooed the valuation argument as a reason to be cautious. So what do you think is then a reasonable valuation, and when do you start to pay attention to it?
That's a trap question, Sarah. Thanks for trying, but I'm not going to give you a number, because I think anybody that says 22 times is the number, that's simplistic math. The market is not as easy as coming up with a valuation metric and an earnings target. That doesn't equate to how you model markets. We model markets from a macro PE compression, longer-term PE trends, and a dividend discount model. When you take a look at a dividend discount model, we can squarely get to 6,700, especially where rates are going to go. With respect to where you look for value overall, we can talk about that. We've been bullish in print in the published marketplace for well over a year on small cap stocks. Other people talk about small cap stocks, and we've been in print on it. Why? If you take a look at all valuation metrics, not just PE, if you look at PE, price to sales, price to book, price to free cash flow, operating metrics like return on assets or return on equity, Sarah, these small cap companies look amazing, and we're starting to see more and more broadening out with respect to performance there. From a fundamental perspective, we really think small cap stocks and mid cap stocks are going to do amazing over the next 3 to 5 years.
That said, ladies and gentlemen, let me know what you think about this information down below in the comment section. Personally, let me know what stocks that you are currently buying, what you have been adding to your portfolios. I would love to to look into some of them because I have quite a bit of small cap, mid cap exposure, but you know, I'm always looking for the next big one as well, and sometimes you guys get to it before I do. So let me know what you guys are looking at down below in the comment section, because I agree with BMO. I think it's going to be an outperformance of small caps for years to come. I mean, small caps have underperformed for 4 years. It's probably time for small caps to outperform for a period of time, especially as we normalize rates, hopefully avoid a recession. So let me know what you guys think about all of this information down below in the comment section. Have a great rest of your day, and I will see you in the next one.